This is part 4 of our Chapter 3 video lecture series, and we're going to learn about deferral of revenue or deferred revenue, where we get the cash ahead of time in a previous accounting period. And in that previous period, now we owe merchandise or we owe services to our customer. And then later on, as we provide the service, only then we're going to record the revenue and reduce the liability we owe. Or another way is to provide the services already in this period, but collect the money later on. So in the meantime, we're going to we're going to accrue a receivable from our customer and collect the cash in the next period. So the first one is that deferred revenue or deferral of revenue. So we're going to already collect the cash. So let me draw the cash T account in here. The collection of the money here, debit to cash, already happened in the previous month. And at the same time, now we're going to be owing services, owing merchandise to our customers. Owing is a liability. Liabilities are increased with credits. So this debit and this credit happened in the last period or previous period. But now in the current period, the next period, we earned the money because we did the work. We provided the merchandise. So we're not going to owe this anymore. So we're going to reduce the liability with a debit. And you can see the posting from this journal entry here. And because we earned it now, we're going to record the credit in this subsequent period after the period we had collected the money. So let's take a look at this example where we have Fast Forward again, the company we've been covering this past couple chapters, and they received $3,000 from their customer in advance before doing anything. And it's going to cover 60 days worth of services. The collection of the money happened on December 26. So we debited cash, increasing our cash asset, but we cannot credit a revenue account. This is not a revenue account. Whenever you see the word unearned, that's an indication you're dealing with a liability account, even though you see the word revenue here. And we owe, crediting this liability, $3,000 worth of consulting services to our client here on this date. And that's going to be now paid back to them in services for the next 60 days, of which there's only 5 more days this month. So we're going to earn 5 out of the 60 days worth of this $3,000 here in the current month of December. So I think that comes out to $50 a day for 5 days, or a total of $250 being earned here in December. And the rest will be earned next month in January. But we got the money up front. Okay, so now we don't owe all 3,000 at the end of December. We got to reduce this liability by this 250. You can see an alternate calculation here to get to 250. So here's the adjustment we got to make at the end of the month. Reduce the liability, debit the liability for the days of services we provided, those 5 days here in December. Here's the rest of the liability that we're going to pay back in services next month. And then because we need an offsetting credit to this debit, here's the credit we've earned. Again, another term for revenue being recorded with a credit. So the previous credits here you can see was probably work we did that we had billed and or collected during December. But this 250, remember, we already collected back here on this date, and only now we've earned 250. And we're going to record an adjusting journal entry for this 250. Here you can see the journal entry journalized in our general journal, reducing the liability, debiting unearned consulting fees, at the same time reporting the revenue, crediting the revenue. Again, journalizing comes first, and then you post to the ledger accounts. The way we see the order here is just for illustration purposes to help us analyze how to record the transaction in the first place. So let's take a look now at the accruing of revenue, accrued revenue, where we're going to collect the money, the cash, not in the current period where we earn it, but in a future period. Okay, so we need to record the revenue right now, here in this period that we earn it, but we're not going to be debiting cash asset, but we're going to be debiting the receivable asset. Yeah, receivable. Whenever you see the word receivable, you know you're dealing with an asset, maybe specifically the accounts receivable asset. So here on December 12th, a customer agreed to pay us $2,700, but that payment is not going to be made until next month, next accounting period on January 10th. We're going to provide services though from the 12th through the 10th, December 12th to January 10th. That's 30 days, of which 20 of them fall here in the current month of December. In other words, we're earning two-thirds of that $2,700 that we haven't yet collected. Now, when you enter into the contract here on December 12th, there's nothing to journalize because you haven't collected the money. You haven't earned anything yet. But now, here at the end of December, time to update our accounts, our general ledger accounts. We've earned two-thirds of this 2,700 or 1,800. Again, we haven't collected it yet, but you don't wait to collect the money to report how much you earn. Here is the adjustment we gotta make at the end of December. Record that revenue we earn, 20 days worth of consulting fees, and then not debit cash. That cash is going to come in next month on January 10th. But in the meantime, we have the right to receive that money. So that's the accounts receivable asset being increased with a debit. So we journalize it here and then we post it to its respective ledger accounts in the general ledger. So again, we'll collect this next month, right? And here's the amount we've earned now for December, including the amount we had accrued at the end of December, including here any amounts we already had billed or had and or collected during the month of December. So the tricky thing is now when we do collect that $2,700 next month on January 10th, we got to keep track of how much was already recorded as revenue here in December and how much is now going to be recorded as revenue in January. So here is the journal entry you have to record when you collect the money in January 10th. You get the money, that's the easy part, debit cash for the full amount. But now the credit is not all to revenue because that 20 days back in December, the revenue was already recorded. December here, already recorded for those 20 days. Yeah. So you don't want to double count the revenue. What you are collecting though is on this accounts receivable. And because that receivable asset is no longer a true asset, you got to reduce it with a credit because the customer is paying you off. And then here is the 10 days in January that you've earned being recorded as revenue in January. Yeah. At the time you earn it. And again, not necessarily when you collect the money, but at the time you earn it. Okay, I think that's all for revenues here. So when you come back, take a look at the next video, and we're going to talk about the formal process, yeah, of all the different steps, eventually preparing a classified financial statement.